So, good evening. So, today we are going to run through the group accounts under the corporate reporting, and we have a lot of things to explain to ourselves, on this group account. So, when we fully understand what we want to discuss with ourselves on this group account, then I think the remaining one is very minimal because we are going to be working towards all those things. Number one is that we have to ensure that we really understand. So we need to explain what is group itself before we think of the group account. So when we say group, I hope you can hear me clearly.
Yes, sir.
When we say group, according to IFRS 10, this simply means group simply means a parent. Simply means a parent and all its subsidiary. A parent and all what? Its subsidiary. That is what the group is talking about. To a parent and all its subsidiary. Subsidiaries. Then when we now say group account, we've already say the group. According to IFRS 10, group simply means a parent and all its subsidiary. But when we now try to term it with a group account, so the group account, it will not be the account. Are you getting it now? Of the parent company and its subsidiary. I think it's clear.
Yes, sir.
Okay. So we say group, according to IFRS 10, group simply means a parent and all its subsidiary. But when it's now come to group account, let's say group account. So let's reason together concerning this as I explain now. Group account is the what? Is the account, let the class be interactive, please. Is the account of what? Parent company and its what? Subsidiary. So the account of parent company and its what? Its subsidiary. Are we there?
Yes, sir.
So another thing that we also need to think of, it is the consolidated consolidated statement. Consolidated financial statement. When we say consolidated financial statement, what we are trying to do is that it is a financial statement of the parent company and all its subsidiary. So when we say the consolidated financial statement, we refer to as the financial statement of the parent and all what and all its subsidiary that we prepare and presented as if it is a word, it's a single entity. Are we together? Hello? Hello?
Yes, sir.
Together, sir.
Okay. So what did I just explain now? I want to know maybe if you are following. What did I just explain? What did I just explain? I want to know if you are following.
You explained consolidated financial statement, and then you said is a financial statement of the parent company and all its subsidiaries prepared as a single financial and as a single account.
Okay. So that is when we are trying to do consolidation, we have to consolidate the parent and subsidiary together. We now present it as if it's a single entity. That's what we mean by consolidated financial statement. That is a statement, a statement prepared and presented as if they are what? They are economy single entity. They are economy single entity. Are we good to go? I think we are taking it gradually. Then another thing that we can also think of is that let's think of the parents. So what is parents? Based on what we are saying since, the parent is an entity that control one or more subsidiary. That's what I mean by parent. Parent is an entity that control one or more subsidiary. That's according to IFRS 10. When they say parent, parent is an entity that control one or more subsidiary. Are we together? Another thing is that
Yes,
let
sir.
us now think subsidiary itself. We say parent is an entity that control one or more subsidiary. So what is subsidiary then? So subsidiary now, if we want to go by say, okay, parent control subsidiary, then what is subsidiary? So subsidiary is an entity that is controlled by another entity called who? Over to you, please. Subsidiary is an entity that is what? That is being controlled by another entity called,
Parents.
The parent.
you say what?
Parent.
Called parent. God bless you. That's according to IFRS 10. That is subsidiary is an entity by another entity called parent. Another thing that we also think of is a associate. Associate. When we say associate, an associate is an entity over which an investor has what is called significant influence. Significant influence. That's what associate is. An associate is an entity over which an investor will have what a significant influence. A significant influence. So when we get to the practical aspect of it, you understand what I mean by that word significant influence. An associate is an entity over which an investor has a what significant influence. Significant influence. And when we say significant influence, we also need to explain to ourselves what is significant influence? Significant influence. Are we still there?
Yes.
So when we say significant
Yes, sir.
influence, okay, when we say significant influence is the power. You know, we said associate is an entity over which an investor has significant influence. Then what is that of that significant influence that an investor will has? Significant influence is the power. That's what I mean by significant influence. Significant influence is the power. And that power, what that power will give to you? It means that significant influence is the power to participate in the financial and operating policy decision. Meaning you don't have control. It's just like if you acquire less than, let me say, if you acquire less than 50%, if you acquire less than 50%, it means that you don't have control, but you have what is called significant influence. And that significant influence that you have will give you power. Are you getting that? We give you power to participate in the financial and operating policy decision of that company that you invest on. Is it clear?
Yes, sir.
Any question before we move on? Hello? Can we move on?
Yes, sir.
Yes,
Okay.
sir.
Am I talking? Okay. So another thing that we also need to think of is called pre-acquisition, pre-acquisition reserve, or let's say retained earnings. Pre-acquisition reserve, retained earnings, or let's say profit. So this pre-acquisition reserve, or in some places they will say pre-acquisition retained earnings or pre-acquisition profit. What this implied is that this reserve arose. This reserve arose before the acquisition of the business. That's what I mean by pre-acquisition reserve or pre-acquisition retained earnings. So this retained earnings arose before the acquisition of the business. What I'm saying is that if, for instance, let me cite the example. For instance, parent company A acquire 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 B. At the time of acquisition, at the time that A will acquire B, what is the retained earning of B that time? What is the retained earning of B? That's what I mean by what pre-acquisition retained earning. So pre-acquisition retained earning, these are the earnings by the subsidiary company before being acquired by the parent. You get it now? The retained earning of the subsidiary before the parent acquire the company. Is it clear? Is it clear? Hello?
Yes,
Yes,
sir.
sir.
Can we move on? So
Yes, sir.
we think of the opposite. Post acquisition, post acquisition reserve, or you call it post acquisition retained earning or post acquisition profit. It is the opposite. That is the reserve that is arose after the acquisition. You know that one is a before the acquisition. So this time around, it's a reserve by the subsidiary company after being acquired by the parent. One is before, one is after. So which one is before? Who can remind us? Which one is before? Based on the explanation. Which one is before?
The pre-acquisition.
Pre-acquisition reserve.
Okay, before. So which one is the after?
Post-acquisition reserve.
Post-acquisition.
Okay, after. Do you get it now? So it means that when we say pre-acquisition reserve, what we are saying is that the reserve that is arose before the acquisition of the subsidiary. Then post is the after the acquisition of the subsidiary. Now, another thing that we now think of is the types of subsidiary. There is type of subsidiary. Type of subsidiary. Number one, we have what is called wholly owned, or we call it fully owned subsidiary. Fully owned subsidiary. Fully owned subsidiary. Are you there?
Yes, sir.
Hello? Okay. Fully owned subsidiary. So when we say fully owned subsidiary, we are talking of the subsidiary in which a parent company has a control interest of all everything, which is control interest of 100%. That's what it means by fully owned subsidiary. When a parent acquire everything, that is, a parent will have control of 100%. We call it fully owned subsidiary. Fully owned subsidiary. So that if you read a question and you discover that the parent acquire 100% of the subsidiary, what they are saying is that they fully own subsidiary. So please give me like 2 minutes. Hold on, please. Hello, I'm back. Are you there?
Yes, sir.
Hello. I think the fully owned subsidiary is okay now. Can we move
Yes,
on?
sir. Yes, sir.
I said, is the fully owned subsidiary okay now?
Yes, sir. Yes, sir.
Yes, sir.
Okay. So another one is that we think of when we say fully owned, then we think of what is called partly owned subsidiary. So when we say partly owned subsidiary, as the name implies, when a subsidiary, when a parent company acquires subsidiary with the hope of controlling interest of more than 50%, but less than 100. So when a parent company acquires subsidiary with the hope of what? Having control interest of more than having control interest of more than 50%, but less than 100. We call it what? Partly subsidiary, or we call it partial. Anyhow you call it, partial or partial owned subsidiary or partly subsidiary. Is it clear? When a parent company acquire the subsidiary with the hope of what? Having control more than 50%. That if the parent company acquire 51%, then we say it's a partly subsidiary, that the parent having control of 51%, but less than, that means can be 51 up to 99. That is 51% less than 100%. And more than, that's why I say more than 50%. But if the parent company acquire exactly 50%, that's what they call joint venture. Joint venture. Is it clear? Can we move
Yes,
on?
sir. Yes.
So another thing that we can think of, we call it fellow, fellow subsidiary, fellow subsidiary. So when we talk of the fellow subsidiary, when two or more subsidiary, when we have two or more subsidiary, we call them a fellow subsidiary. That is, a parent company will control two or more subsidiary. That's what I mean by what fellow subsidiary. Like if entity A, that is company A, is controlling company B, company C, company D, that's what I mean by what fellow subsidiary. Fellow subsidiary is as a result of when we have two or more entity, we call them a fellow subsidiary. So if these two or more entity are controlled by the same parent, that is parent company, which is a company A, is control company B, the same company A control C, the same company A control D, the same company A control E, we call them what? A fellow subsidiary. Is it clear? Hello.
Yes, sir.
Yes, sir.
Another thing that we can think of, we
Yes,
call
sir.
it sub subsidiary. Sub subsidiary. Sub subsidiary. When we say sub subsidiary, what we are saying in the essence is that if an entity or a parent company is control a subsidiary, and that subsidiary is now control another entity, we call it a what? A sub subsidiary. Let me give you a practical example. If company A control control company B, A control B, and this B that you see, this B that you see here, this B that you see here now control C. We call it what? Sub subsidiary. Company A control B, but this B now control what? C. We call it what? Sub subsidiary. Are we good to go? Are we good to go?
Yes, sir.
Another thing that we can also think of, we call it foreign subsidiary. Foreign foreign subsidiary. When we say foreign subsidiary, what we are saying is that when a subsidiary is situated or a subsidiary is located in a country other than the parent, other than the country of the parent, we call it foreign. For instance, if a subsidiary is located here in Nigeria, but the parent company is located in UK, we call it what? Foreign subsidiary. Or if a parent company, if a subsidiary company is located in USA and the parent company is located in Ghana, we call it what? Foreign subsidiary. Is it clear?
Yes, sir.
Are we good to go?
Yes, sir.
Okay, then this is what you need to know before we can now think of how the question will look like. We need to understand the control, that if there's a control, then we need to know that which one is the parent and which one is the what? Subsidiary. Should I move on? Hello.
Yes, sir.
Yes, sir.
Now, what I want us to also learn, because if I'm not mistakenly, I think you've already have the basic knowledge of the group account when you do your FR. But at the same time, we also need to share more light so that Sorry, hello, I'm back. It's network. Can you hear me?
Yes, sir.
Okay, I'm back. It's network. So, can you see my screen now? Can you see my screen?
Yes, sir. We can see your screen.
So, as I was saying, I said when you now check all this in your question, that what is the control of the parent, or what is the stake of the parent in this business? Is it fully stake, which is fully owned, which is 100%? Is it partly owned, which is a 51% but less than 100% stake? Is it what's it called? Is it a question on the fellow subsidiary? Is it question on the sub-subsidiary? So you have to identify all this. After identifying it, you now go again and check the question, what is the policy that the company is using? And we have two policy of determining or measuring the non-controlling interest. Number one policy of measuring or determining the non-controlling interest is that the non-controlling interest can be measured using what is called fair value, or another name for that fair value method, we call it full goodwill, FULL, full goodwill method. Number two method that you can use to measuring or value the non-controlling interest is called proportionate. Proportionate of what? Identifiable net asset. Proportionate of what? Identifiable net asset. Are we there? Hello?
Sorry, sir. What did you say number one is?
Number one is the fair value or full goodwill. That's another name, fair value method or full goodwill. Fair value method. Fair value. Fair value method. Or we can call it full goodwill. Full goodwill. That is number one method that we can use to what? To measure or valuing non-controlling interest. Number two is that proportionate. 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 Sorry, spelling. Proportionate of subsidiary identifiable net asset. Identifiable. Subsidiary identifiable net asset. So that is the second method. So this will be given to you in the exam. Whether the examiner wants you to use fair value method or full goodwill to value your non-controlling interest, or the examiner wants you to use what we call proportionate of subsidiary identifiable net asset. But for examination purpose, are we there?
Yes, sir.
Yes, sir.
For examination purpose, the non-controlling interest should be measured. For examination purpose, the non-controlling interest should be measured based on the group policy. You understand? You cannot just say, okay, they are giving you questions and you want to use any policy that you like, probably because you know one, you don't know one. Now say, let me use this or no. For the purpose of exam, we have to value the non-controlling interest using what? Based on the policy of the group. That is, if I say policy of the group, I'm talking of the policy of the parent company. So that is why I say when you take that question, you have to check the policy of that company. So which policy they want to embark on? Is it policy of proportionate or subsidiary net identifiable net asset, or policy of fair value method? But when that policy is not expressly stated, are you following?
Yes, sir.
Yes, sir.
But let's assume the fair value, let's assume the policy in that question. Let's assume the policy is not expressly stated by the examiner. Let's assume the examiner is not stating it, the policy to be used. Then that NCI should always be measured at fair value, provided the following condition that I want to mention. Are you following at all?
Yes, sir.
I said if the policy of the company is not expressly stated by the examiner. So if the examiner didn't state it, then what you are going to do is that that NCI need to be what? Measured at fair value, provided the following condition. That is, all this condition, provided this condition is, probably the condition is available, then we can say we need to go ahead by fair value. So what is the condition we want to talk about? Number one condition, are we on the same page?
Yes, sir.
Yes, sir.
Yes, sir.
Number one condition is that if the market price per share of that subsidiary, market price per share of that subsidiary on acquisition date is given to you. Let's assume in that question they mention market price per share of the subsidiary, if they are giving you something like that. Number two is that if the fair value or market value of the subsidiary is also given, if probably they are giving you the fair value or market value of that subsidiary, if they are giving it to you, then we can go ahead. It's part of the condition that we must ensure that it is available. Not all of them that has to be present is either one among what I'm going to tell you. I said number one is that the market price per share of the subsidiary, if it is given. Number two is that the fair value or market value of subsidiary, if it is given. Number three is that if the fair value of non-controlling interest, because in some question they will tell you that the fair value of non-controlling interest is so. So if you have a situation like that, that the examiner mentioned that the fair value of non-controlling interest is so amount, automatically it is given already. Then you are using the fair value method. So that's number three. So if the fair value of non-controlling interest is given, are we on the same page? Hello.
Yes, sir.
Yes, sir.
Another thing is that what was it called? Another thing that we can think of. I'm coming, let me remember. If the goodwill attributable to NCI, if that goodwill attributable to NCI, whether there is a goodwill, that goodwill now, the one that is attributable to NCI, if that one is also given, then you are good to go to use the fair value method. That is why I said it, that I mentioned four things, and I said any of the points, any of the available points I listed earlier, it is not everything. It is any of those fours, any of the 4 points that I listed earlier. If one is there, then you go ahead, because the examiner is not expressly state the formula, the method to be used. So in my first explanation, I said if the examiner is not expressly stated what you are going to use, then you will use the fair value method based on the first scenario I listed out. Are we together?
Yes, sir.
Yes, sir.
Okay. Another thing that we also need to think of after we are able to identify all these things in the question, that you identify the stake of the parent, you identify the stake of the subsidiary, you also identify the policy of the company. Then another thing is that you also identify the policy. Then another thing that you also need to think of is that the structure, the steps that involve when you are solving a group account. The steps involved in solving a group account. Number one step is that you have to draw what is called group structure. Group structure. You will draw the group structure. That is step one. The step one, that is, you are ready to solve a question now. So what is the step that you need to follow? Number one step is that you want to start the solving now. You have to draw what is called group structure. Are we there? Hello?
Yes, sir.
Number two, when you draw the group structure, number two is to do what is called computation of what? Net asset of the subsidiary. You do what is called net asset of the subsidiary. That is step two. After the group structure, go ahead and do what is called net asset of the subsidiary. That you have to do computation of net asset of the subsidiary. Number three is that you have to compute for what? Goodwill on acquisition. Goodwill on acquisition. Are we there? Are we
Yes,
there?
sir.
Yes, sir.
Yes, sir.
Yes, sir.
What number are we?
You just completed number
We're
3.
going
What did I mention in number one?
to draw a group structure.
Draw a picture.
Okay. Number two.
Do a computation of net assets of the subsidiary.
Number three.
Compute the goodwill on acquisition.
Okay. So after that, number four is to calculate the consolidated retained earnings. Consolidated retained earnings. Consolidated retained earnings or consolidated reserve. Or, it depends on what the examiner give, whether they mention reserve or retained earnings. So consolidated retained earnings. Number five is to compute for non-controlling interest. Non-controlling interest. Compute for non-controlling interest. Number C. Are we there? Should I move on?
Yes, sir.
Yes, sir.
Number 6 is that compute for investment in associate, if any. Suppose the question given to you, it is the question that entails parent, subsidiary, and associate. Then you have to do computation of what? Investment in associate. What number are we?
Completed number
What
6.
Number
number are we?
7 now.
Number 7 is that,
We're going to number 7 now.
okay, number 7 is to prepare the consolidated financial statement. Consolidated financial statement itself. Consolidated financial statement. So whether the question is telling you to prepare the consolidated statement of financial position, so it is the financial statement. So consolidated financial statement. Can we move on? Hello.
Yes, sir.
Yes, sir.
Now let's think of one small example before we can take it to complex way. You know, like I said, even though I think in our first class I said before we can think of the complex question, we need to understand the basic of those things, because it is all these small questions they now lump together to make it complex. It's when you understand the concept of basic one to make a what a complex question for examination purpose. But we need to understand the basic before we can think of the complex one. Let's say online class. Acquire 80% of the let's say entity of the, I want to use one name. Online class acquire 80% of the, let's say, equity share of students on first on January 1st, 2024 for 250 million. Naira. When the reserves are to, let's say 10 million naira. When the reserves to 10 million naira. And the fair value of students. Are you there? Hello.
Yes, sir.
network, but I'm back. Can you hear me now? Hello.
Yes, we can hear you.
Okay. If I may ask, where did I stop? Is it when I'm giving example, or you miss a lot, or it is when I'm saying we should do example before you start hearing me? So that I will know
When you
where
were
to continue.
dictating, when you were dictating the question, sir.
The question, okay, good. So, and the fair value of identifiable net asset of students on January 1st, 2024 was as a 230. $280 million. 280 million naira. It is the policy. It is the policy. It is the policy of the group. It is the policy of the group. Are we still there?
Yes, sir.
Yes, sir.
Okay. To measure the policy of the group to measure non-controlling interest. To measure non-controlling interest, which is a SCI. To measure non-controlling interest on acquisition based on the proportionate share of identifiable net assets. Net assets. Are we there? Required.
Yes, sir.
Required. Compute the goodwill. So, if you look at this, one person should read it for us. One person should read it for us, please.
Okay, online class acquired 80% of the equity share of students on January 1st, 2024 for 250 million, when the reserve stood at 10 million, and the fair value of identifiable net assets of students on 1st of January 2024 was 280 million. It is the policy of the group to measure non-controlling interest on acquisition based on the proportionate share of identifiable net assets. Compute the goodwill.
Okay. Compute the goodwill. Let me put different thing to do. Compute the goodwill. Okay. Require. Let me say number one. Construct. Let's do it that way. Construct the group the group structure. Number 2, compute. Are we there? Compute the goodwill. Compute the goodwill. Are we there? Hello?
Yes,
Hello?
sir.
Yes, sir.
Okay, compute the goodwill and show the accounting treatment. Accounting treatment. Let's do it that way. Show the accounting treatment. So, you can see if we want to tackle this now, we have to do what is called group structure. But we need to ask ourselves, is this question, is it a fully owned subsidiary or partly owned subsidiary? Let's start from there. Is it fully owned subsidiary or partly owned subsidiary? I'm waiting.
Partly owned
Part, why,
subsidiary.
Partly owned.
why is it partly owned?
Because the parent has a control of over 50% and less than 100%.
100%. That is only acquire 80%. Then that is where we can now say we want to draw our group structure. So then, drawing our group structure, group structure. So this group structure now, we can now say online. Online. Acquire, this is the structure. 80%. Acquire 80% of what? Students. Students. So if online acquire 80% of students, it means that it acquire 80% out of 100. Then the remaining one is how many percent? 20%. And that 20% we call it what? Non-controlling interest. That is the percentage that belongs to outsider. Is it clear?
Yes, sir.
Hello? So this is the group structure. This is the group structure. This is the group structure. Number 2. Number 2. What they ask us to do in number 2? Number 2, they ask us to do what?
You
Compute
should
the
compute
goodwill
the
and
net
show the
assets of the
accounting.
subsidiary.
No, number 2. Compute the
Compute the
Compute
net
goodwill.
the goodwill
assets.
and the accounting entry.
Okay. I understand what that lady was saying based on the step. Yes. But this question is only telling us what to prepare. The question says we should construct the goodwill for the question 2. And that step, I said when you construct the goodwill, you have to do what? Compute the net asset of the subsidiary. But here, in this question, you don't need to compute the net asset of the subsidiary because you are given already. They said, and the fair value of identifiable net asset of the student was 280 million. Is it clear, my sister?
Yes, sir.
Yeah, they've already given it to you, so no need of computing the net asset of the subsidiary. They're already giving you the value here. So after that, just go and compute your what? Your goodwill. Is it clear?
Yes, sir.
Computation of what? Goodwill. So this computation of goodwill, then you can now start by when online acquire students, how much do you think online pay? Let's read it once again. Who can read this part? To know how much online pay to acquire students.
Online class acquired 80% of the equity share of students on January 1st, 2024 for 250 million. That's the
Okay,
cost of
God bless you.
investment.
Yeah. Because when online acquire 80% of students, online pay 250 million to students for acquisition. Then we call it cost of investment, or we call it consideration transfer. Consideration transfer. That is the amount that online pay to student when it acquire it. Consideration transfer 250 million. Are we good to go?
Yes, sir.
So, and then if you now go to the question, what is the policy? You know, I say you should know the policy. What is the policy of the company for valuing the non-controlling interest? What is the policy? What is the
Proportionate.
policy?
The policy is proportionate share, sir.
Okay, the policy, they say it is the policy of the group to measure non-controlling interest on acquisition based on the proportionate share of what identifiable net asset. Then you can now come here and say add your NCI, that non-controlling interest, you are adding it. Then based on proportionate. Then what is the percentage of NCI? When you acquire 80, what's the remaining percentage of NCI? 20%. Yes or no?
20%, yes.
Yes.
Multiply by what is the proportionate they are talking about. I think they gave us that one too. They said the fair value of identifiable net asset. Can you see? I said the policy, it is proportionate share of identifiable net asset. And they've already given us the identifiable net asset to be what?
280
To be
million.
what? To be 280 million. To be 280 million. Then what do you have? 20% of 280 million. What do you have? Answer me, please. Hello?
56 million.
50
56.
what?
56 million.
6 million. Then you can now add it because we want to add 56 million. 56 million. So when you add it, what do you have? 250 plus 56.
306 million.
306. Now, when you have 306, then you can now come here and say less the net asset of the subsidiary. Net asset of the subsidiary. You now come here and less the net asset of the subsidiary. So let's go to the question. What is the net asset of the subsidiary? 280, right? The fair value of the net asset of the subsidiary. 2 what?
280 million.
280 million.
So
Yeah, the net asset of the subsidiary, it is 280 million that you need to less. So when you less, what do you have?
26.
26 million.
26 million. So 26 million is your goodwill. So if you look at this 26 million, is it positive or negative? Is it a positive or
Positive.
negative? Positive, we call
What
it positive,
good
positive
goodwill?
goodwill. Goodwill. If it is negative, we call it negative goodwill or gain on bargain
Bargain.
purchase. That's another name for negative goodwill. A
Gain and bargain.
negative goodwill is called gain on bargain or negative goodwill. Either you call it gain on bargain purchase or negative goodwill. So this is the goodwill that they ask us to compute. It's a positive goodwill. Then we can now think of the accounting treatment. I think they said we should also do the accounting treatment, right?
Yes, sir.
Hello, to accounting treatment. So
Yes.
since it is a positive goodwill, the accounting treatment is that, are we together?
Yes, sir.
So the accounting treatment is that this goodwill that you see that we got, we have to take it to statement of financial position. This goodwill of this 26, we are taking it to what? Statement of financial position. Hello.
Yes, sir.
Yeah,
I'm with you, sir.
Okay, that's the accounting treatment. Because that 52 will be what? Will be taken to statement of financial position as part of your goodwill
So
now.
I didn't
Part
get the
of,
accounting treatment.
okay. We have positive goodwill.
Yes.
Positive, positive goodwill. That positive goodwill that you got when you are preparing your statement of financial position. Let's assume the examiner asks you to prepare statement of financial position. You will take this 26 as part of your goodwill. The format is that you have non-current assets. When we have property, plant and equipment, goodwill, so that goodwill, this is what will form part of your non-current assets. This 26. That's why we say we are taking it to what? Statement of financial position. Is it clear? Hello. Hello.
I'm hearing. We are hearing you, sir.
So, but let's assume it is a negative goodwill. Let's assume it's a negative goodwill. You will not take it to statement of financial position. You will take it to consolidated retained earnings. Is it clear? Let's assume that goodwill is a negative goodwill. You will take it to where? Consolidated retained earning. Consolidated retained earning as called what? Gain on bargain purchase. You just go and add it to your consolidated retained earning if it is a negative goodwill. But since it's a positive goodwill, we will take it to what? Statement of financial position under our non-current assets. Is it clear? Hello.
Yes, sir.
Yes.
Okay. Uh so I think you guys have class after this class. So let's talk from here. Then the next class, we are going to look at it at a complex way. I think for now we have the basic knowledge of what we are expecting and what are the small adjustments that we also need to do. So maybe our next class we also do little small adjustment, then we take it to the complex. Any question, please? Any question? Any question? Hello? Are we there?
No, sir. From my end, no, sir.
Okay, others, any question before we call it a wrap?